easyJet's third quarter pre-tax profit fell 70%, from £286 million a year ago to £85 million now. That collapse lands 3 weeks after the airline agreed to a £5.7 billion takeover. Revenue actually rose 2%, to just under £3 billion, and passenger numbers barely moved. The damage sits entirely on the cost side, which means the question is not whether people are still flying easyJet, but what specifically broke the cost line. Fuel costs rose by £105 million, with unhedged fuel peaking near $1,800 a metric ton in April. That spike traces directly to the Iran war, which sent oil prices rocketing after hostilities broke out in February and pushed jet fuel costs up 17% for the quarter. The same conflict also cooled demand. Passengers grew nervous about fuel supply and delayed booking, and the load factor slipped 1.3 points to 88.9%. Late bookings in the final weeks partially offset the slowdown, but not enough to stop the seat-filling rate from falling behind last year's pace.
A 70% profit drop would normally be the whole story. It isn't here, because easyJet is also mid-takeover, and the premium attached to that deal is not evenly distributed across risk. 2 U.S. private equity firms have been bidding against each other. easyJet's board first accepted a £5.5 billion offer from Castlelake, then switched to a higher 715 pence a share offer from Apollo, worth £5.7 billion, an 81% premium to the pre-bid share price. Days before this earnings report, Reuters cited an EU official saying the bloc is preparing to review airline ownership rules, specifically to stop non-European investors gaining effective control of regional carriers. EU rules already require 51% local ownership, and the official flagged that Apollo has not explained how its structure meets that bar, while Castlelake had already named EU citizen co-investors. The market reaction split in 2 directions within 48 hours. easyJet shares fell 12% on the ownership review report, then rose about 5% the next morning on the earnings release itself, before settling to a 1% gain. That is not one interpretation losing to another. It is the market pricing 2 live scenarios at once. Chief Executive Kenton Jarvis dismissed the review's relevance to the deal timeline, saying the EU proposal isn't expected until early next year, with a consultation running 2 to 3 years after that, far slower than Apollo's own bid clock. He would not comment on the takeover directly.
Jarvis's timeline argument only holds if the review truly moves as slowly as he says. The variable that decides this isn't the quarterly result already reported, it's whether Apollo can even table a binding offer before the structural question is resolved. Under UK takeover rules, Apollo has until the 7th of August to table a firm offer. That date now carries more weight than it did 2 weeks ago, because it forces Apollo to either commit to an ownership structure the EU has just signaled concern about, or let the process lapse back toward Castlelake's already cleared structure. That is the buried assumption behind the market's initial relief. A higher headline price is not automatically the more likely deal to close. Analysts have already flagged that the bidding war itself risks becoming a distraction rather than a clean value signal for shareholders. For a current holder, the trigger is whether Apollo files a firm offer by the 7th of August with a clarified ownership structure. That confirms the premium is real. If the deadline passes without clarity, the structure becomes the trap and the deal reverts toward Castlelake's lower but cleaner offer. For a watcher on the sidelines, the same EU review language is the signal. A narrow review focused only on new deals leaves this takeover intact, while explicit retroactive scope turns the sell-off into the entry point rather than the earnings drop.